Okay, if we can all have a little bit of quiet. Thank you. Thank you. Well, thanks for coming. We were so overbooked tonight, it's taken a bit more time than usual to get you all through the cloakroom, so apologies for that. But welcome, everyone, those of you joining us in the room and also joining us on our video, to the first event of 2025 for the Leisure Property Forum. This is our flagship event, the annual review, where we look back over 2024, which was the usual roller coaster, perhaps not the huge mega events we've had in the last 5 years, but still plenty going on. And we look ahead to the remainder of the year. Thank you to CBRE for hosting us tonight, for generously looking after us and sponsoring tonight's event. We're very grateful. As a non-profit organisation, the LPF needs sponsors to help them put this content out. So our panel tonight, it's being chaired by Alice Keown of British Land, who's the Leasing Director, Hospitality and Leisure. We then have Simon French, who's done a few of these, and backed by popular demand, the Chief Economist and Head of Research at Panmure Liberum. Okay, right, fair enough. If you could move somewhere else, Simon. Let's see if you move now. Sammy Jones, who's a co-founder at Starker, one of our most innovative agencies, acting for landlords, councils, and tenants, I believe. Sammy, that's right. We'll be covering food and beverage and the sort of restaurant sectors. Nigel Costain from CBRE, Senior Director, Head of Restaurant and Leisure. We'll follow up with the big box stuff and everything else. Lots going on in that sector. And last but not least, Eddie George, Partner, Head of Retail and Leisure Investment at Montague Evans, will talk us through the investment market. And keep your eyes peeled for my deal in there. There's always no team deal lurking somewhere in the background, basically. Not the biggest, but we're pleased to have done a sale during 24. So I'm now going to hand over to Simon to do our first presentation.
Don't applaud now. I haven't said anything, although presumably that was for Ashley. Right, well, thank you very much for the return invite. I think this might be my 4th or even 5th year doing the LPF, so thank you very much for that. There are two of my very photogenic colleagues on the opening slide. My photo, bottom left, was taken when I didn't have 2 young daughters, so I had more hair, so that's why it shrunk to the size that it is. So what are we going to do in the next 15 minutes? Going to cover 4 real themes in terms of the UK economic outlook. I'm mindful you'll hear from a lot of leisure sector specialists, a lot of property specialists. I'll give you more of a macroeconomic overview of how I see the economy evolving from here. The last couple of years I've spoken, actually, I've been far more bullish than market consensus. That proved to be the right place to be back at the start of 2023. The expectation from the Bank of England was for the biggest recession in 100 years. That didn't quite happen. Last year, there was the expectation for no growth at all. And actually, the UK economy, at least in the first half of the year, was the fastest growing economy in the G7. It didn't stay that way in the second half, as you may have noticed. But actually, the year as a whole worked out better than anticipated. This year very much looks like a year of 2 halves, a particularly tricky first half of the year, H1, because growth momentum, as I'm sure you've noticed, has slowed across the economy. And we'll go into why and what the key signals are for that. But the outlook for H2 is more favourable, and I'm mindful of sounding like one of those companies that says, don't worry, all our earnings are second half weighted, and you all shout, that stinks like bullshit. So I hope I'm not the economist that that sort of sounds like a sort of public PLC CFO promise you second half weighted earnings when it's not going to happen. But I think there are good reasons why the second half of the year the UK economy will do rather better. Good news for this audience, particularly those exposed to property, which is pretty much all of you. We think more interest rates will come than the market is pricing. The market price, if you look at the curve today, expects 2 interest rate cuts from the Bank of England. We think 6, and we'll go through why we think that'll happen. And then what are the policy options for Rachel Reeves? Should, if it's her, of course, who's still in charge on the 26th of March, when the OBR update their economic forecasts, if bond yields remained as elevated as they are, well, at least certainly 10 days ago, they've come down a little bit since then. So some visuals. These are a set of measures, 4 measures of confidence. We've got, actually my my labelling has shrunk, but let me assure you that is a series of business and consumer confidence. All four of them really had been tracking upward from their low point in 2022, mini budget and all that, sort of saw a real dive in all confidence measures. And it had been on a 2-year upward trend, actually. Going into the general election, feels a long time ago, business confidence was at an 8-year high, consumer confidence was at a 3-year high. These are just Z scores for those of you who've done a bit of statistics. That's standard deviations away from the mean, but they've all been trending downwards really since about August, September time, since a combination of the black hole, the broad shoulders, the worst economic inheritance since the Second World War. If you wanted to slow an economy, that was a textbook way of doing it. You crush animal spirits in that way, and it's very clear now in the data that that is what has happened. Sentiment, the darkest of these green lines amongst businesses, has actually held up rather better, albeit those measures, that Lloyd's Lloyd's Banking Group, LBG measure, seems a bit of an outlier from the other measures on this chart, but certainly all of them trending softer. And reminding you what I said at the outset, this comes from an economy that in the first half of the year, the UK was the fastest growing economy in the G7, so quite a reversal. Now, if you are cup half full, and I hope most of you are, you may conclude that this normally happens during change elections. There'll be people in the room who were born in 1979, when Thatcher came to power, 1997, Blair, 2010, Cameron, 2024, Starmer. On each of the previous three occasions, the run rate of growth heading into the election, which is the first of those lines, was rather higher than we saw in the 4 quarters afterwards. You can see that happened very strikingly in 1979-80, when I think there was 364 economists wrote to Margaret Thatcher saying she was on the wrong path. Our profession covering itself with glory once again. But also happened in 97, to a slightly lesser extent, and certainly in 2010. So that pink dot, which is the one data point we have for quarterly growth since the election, Q3, is somewhat in keeping with the post-election slowdown. You normally have the public sector contracting less. It slows down civil servants. I can say this because I was a civil servant for 12 years. They go slow ahead of an election, realizing there'll be a new contracting minister the other side. But then also the private sector wants to kind of know what's going on in terms of what counterparty it's dealing with. So cup half full, if you're a Treasury official who's holding their nerve, you'd say this is entirely consistent with what normally happens around change general elections. But, and I think it is quite a considerable but, it could be that the bond market has said you've borrowed a lot and borrowed a lot for a long time, and we've kind of run out of what I've described as fiscal road. And maybe the mini budget in 2022 wasn't so much the madness of Liz Truss or Kwasi Kwarteng, but was just a sort of the bond market saying, you're running debt too much, you're not the US economy, and therefore we're going to demand higher bond yields. Now, I'm not going to sit on the fence, because that's boring, isn't it? But I could run out of memory of the number of journalists who've called me since the budget in late October and said, well, is this just another mini budget event? On the left, Rachel Reeves and what it did to 10-year bond yields, UK, US. US in green, UK in purple. Good luck if you can see a UK delta there. Largely, since the budget, it has been US events and obviously the election of Donald Trump that has been driving bond yields higher. And when this chart was taken to near their highest level, it's come off a bit since then. I haven't committed a chart crime which often happens. Economists are very guilty of chart crimes. The same axis for Kwarteng's budget, and you can see a real difference between the UK performance and the US performance. And the US, why is it relevant? Well, it sets the benchmark cost of money for the rest of the world. Very clear UK-specific event there. So at the moment, my conclusion would be the bond market's worried about global debt. It's worried about tariffs. It's worried about what Donald Trump's meme coin will do to the cost of fiat currency. It's worried about lots of those things. It's not really worried about the UK debt position specific to this budget as things stand. H2, because I think H1 will be pretty challenging given those consumer confidence metrics, likely to be more favourable. Well, what's the sort of major concern at the moment, I would say, in global economics, it's about Trump's trade policies. Will he stick tariffs on all his major trading partners? Probably, actually, based on his somewhat rambling speech, but he specializes in rambling speeches. He's certainly going to challenge Mexico and Canada here, who respectively have goods exports to the US of about 20% of their entire economy. So big part of their economic picture. The importance of geographical proximity on trade, which Brexiteers seem to deny for a long period of time. Notice, actually, although China and EU trade an awful lot with the US, that's the green lines, $550 billion worth of goods exports each, actually is a size of their overall economy only about 3 or 4%, a bit like Japan. The UK, down here, actually only 2% of our size of our economy is global goods trade, goods trade with the US. So if we do get tariffs, there are other economies that will be far more materially impacted than the UK. It's not to say we won't be negatively impacted, but it is an order of magnitude rather less for the UK than other major economies. But there are some tailwinds to look forward to, which is quite encouraging. SR, spending review. At the moment, what basically the budget back in October did was take money out of the private sector in the form of employer NICs, largely, and it's going to give it to the state sector to do capital spending. At the moment, we don't know where those projects are going to be allocated, which prisons are going to be built, which roads are going to be enlarged, which water projects, all sorts of public spending. We get clarity of that in the June spending review, and you'll start to see project funding coming on stream. It's one of the main reasons why the second half of the year, likely from just a fundamentals point, to be better growth. There will be a post-NICS adjustment, national insurance contributions that. Core inflation, which will spike in April, it's inevitable. Employers will pass on a proportion, although only a proportion, I would venture, and I'll show later why I think that. And once they've done that in April, I suspect inflation, given relative softness of demand in the first half of the year, is likely to slow. And consumer balance sheets will unwind. And this is particularly relevant for the leisure audience, very exposed to the consumer and their degree to which their precautionary savings that they have done over the last 4 or 5 years, they unwind or they don't. Now, when I stood here 2 years ago, we were about, apologies for disenfranchising the people on that side of the room. I'll come over there for when I'm next pointing out a chart. But here is the total amount of cash held in UK deposit accounts. This isn't survey data. This is the Bank of England knows how much cash we've all got in our bank accounts. And at the moment, we've got, as a nation, just shy of £2 trillion in cash. Why cash do I focus on? Because it's ready. You can go and access it. It's instant access savings accounts. Just shy of £1.9 trillion. Now, back pre-pandemic, we were about £1.5 trillion. So you could make an argument households have got almost £500 billion worth more cash than they did back just 4 or 5 years ago. But you won't have escaped your notice the price level. Consumer prices have gone up about 20%, 25% over the period. So if you adjust for that inflation impact, that's the purple line, that gives you a sense of how much in real terms cash would need to be the same level it was pre-pandemic. And there's still a gap. And actually, you can actually see an awful lot of what has been going on with consumers over this period. I will go to this side, because that will enfranchise the people this side of the room who are falling asleep. So back at the start of the pandemic, there was a lot of excess savings, not a lot of spending, not a lot of inflation. You had a big excess savings gap emerge. Then as the pandemic ended, we start to see more leisure spending, we start to see more drawdown of that savings, we start to see more inflation as the purple line picked back up, and you almost reached equilibrium at the back end of last year, where households went back to what you would describe as their normal level of cash. But actually this loss of confidence in recent months has actually manifested itself in the second chart on the right-hand side, which is quite a sharp pickup in savings each month. This is the amount each household, or total households, put aside each month. And they had been drawing down into their savings, these red bars, in 22, 23, but they've now started saving that. Now, that's bad news for the economy. You want them going out and spending it. But it's actually it's paradoxical. It's actually quite constructive for their ability to spend in the future. But they've got to have those animal spirits to unlock it, to want to go out and spend it. That's the big question mark for the UK economy. So what's going to drive it? And this is where our view focuses on interest rates. So about £1.5 trillion of UK debt in the household sector is held by mortgages. Now, I took for offered rates, for new advances of mortgages, obviously interest rate spikes meant a big increase in the amount that people could take out, the interest rate that people could take out for mortgages, peaking out at about 5.5% after the mini budget. But it took a lot longer for the stock of debt, all the mortgages we have, to start picking up. And actually, even today, the average interest rate on the UK mortgage book is still less than 4%. It's 3.8%. Why? The people you walk up past in the street who are smiling, they're the people who've got 5-year mortgage deals taken out in 2020, 2021. They're still on 1.5%, 2%. Their moments will come. They will have to refinance. Their smile will be wiped off their faces. But it does tell you, if you like, that here was the moment of peak risk for households, when that gap between their current rate and the offered rate was at its largest. Actually, as yields have started to come down, as the Bank of England have cut rates twice, you're starting to see, if you like, that refi moment being rather less painful for households, and some of their money that they've put aside to service those higher mortgage costs starts to get unwound. And that was definitely the story in the first half of last year when the economy was growing as fast, or as the head of the ONS described it as going gangbusters, which it was. This is the damage done by the budget. It's derailed that sentiment to try and take into account what is a slightly better financing picture. So what is the case for UK rate cuts? I've started, so I will finish. So most of the attention on why the UK is going to have a big inflationary problem, the Bank of England's not going to be able to cut rates, has focused on the idea that NICs increases will pass through in terms of this third option, when companies have been asked by the Bank of England what they're going to do, in the form of higher prices. About 55% of companies say we will raise higher prices. So you go, ha-ha, inflation. Going to have inflation rocketing, therefore the Bank of England can't cut rates, we're scuppered. But look at the other options that, by the way, companies are also in largely the same quantities considering. Lower employee wages, lower number of employees, lower profit margins. All three of those, the way I model the economy, are disinflationary impacts. And we've started to see the Bank of England acknowledge this in their commentary. We've had a couple of Bank of England policymakers say, look, this is a sign that employers don't feel they can pass through a lot of these costs. They're taking on other measures. That's quite disinflationary. It means we need to get ahead of things in terms of interest rate cuts, which is why I think we'll get an interest rate cut in February. I think we'll get another one in May, and we'll probably, in my view, get 4 more in the second half of the year, because employers are actually telling us all the attention has been here, higher prices, but most of us can't pass all these costs through to our customer base, so we're going to do other things that are actually rather more disinflationary. We have a problem with the jobs market, penultimate slide in this section before I go into what Rachel Reeves might do, which is we don't have great data on jobs and wages because the labour force survey is rather scuppered. So what we do have to go on is core inflation data. This is stripping out energy and food, which are volatile elements. And actually, you can see the core trends have been trending downwards for about 2 years now. And the last couple of months have definitely seen a real moderation back to what we would describe as normal, the pre-2020 month-on-month average rate for inflation. That's quite encouraging. Slightly less encouraging is the gas price picture. This is the gas price. Obviously, you know prices for spotting where the Ukraine war took place. We have had a bit of a cold patch, which has seen that spike in the last couple of weeks. But overall, a relatively benign energy complex compared to the type of inflation we were dealing with back in 2020-23, which led to that big spike in costs for businesses and for households. So, final section. If I'm wrong, very realistic question to ask. What are the 6 options available to Rachel Reeves? I will rattle through them. First of all, she could have two of the options could be make her life easier, not of her gift, but of Andrew Bailey's gift, which are interest rate cuts and the end to quantitative tapering being the gilts that the Bank of England own, that it's selling back to the market. It could just stop doing that. But otherwise, she's got spending cuts, either benefits or departmental spending. She could pursue more growth-orientated policy, and you can see the announcements on Heathrow, on AI, on trade, trying to get into that mindset which was squandered over the summer. She could play around with the fiscal rules. You know, they're arbitrary. They've changed 10 times since 1997. Why not have an 11th vintage and see whether anybody notices? Or, of course, the one that everybody fears, which is tax increases. I'd have to say, in order of likelihood, of the mitigating factors. I'd probably put it in the same order as I put there. Honestly, while she hasn't categorically ruled out tax increases, it is the Treasury's view that at this point, further tax increases will be pretty self-defeating. So it's definitely down towards the bottom of their list of priorities. I will leave you with one challenge, if you like. One, really to acknowledge that while none of us in this room have particularly enjoyed the tax-raising budget that came along in October, it's part of a sustained trend. This was what Jeremy Hunt had planned, the little purple line. This is what Rachel Reeves has planned. But look what's happened in the 30 years since Margaret Thatcher left Downing Street. It's been on a steady upward trend in terms of the tax burden, with levels of taxation now not seen since the end of the Second World War. But that happens because it's what we want, I'm afraid. You want an NHS that's free, you want social care that's free, you want a triple lock pension, when at a time when the population aged over 80 is going to double over the next 20 years, it's going to come at a pretty expensive price, and you're going to need to pay taxes to do it. Unless you want to revisit those requirements, and the electorate, when asked, say they want it, that chart will continue going only one way. I'll leave it there.
Hi, I'm Sammy Jones, co-founder of Starker. I'm going to cover the F&B market for you all, focusing on potential challenges and opportunities, and just review what we've seen in the market over the last year. According to the Office of National Statistics, food and beverage was the highest performing sector in the economy in November. Demand for London and key regional cities was strong. We saw this firsthand in Manchester in particular, with demand for the 3,000 to 5,000 square foot units being really competitive for restaurant operators wanting to come to the city. And that drove rents up high and made it very competitive for people to try and get in and secure space. We saw a lot more international requirements for space in the UK, together with those international brands expanding their UK presence, with further sites in London and the regions. UK brands such as Permanently Unique Group, who operate Tattoo, Phoenix and Louis brands, also wanted to expand internationally and looking at Middle Eastern markets, and the US was also demand for some operators. We saw a range of requirements come live for regional cities like Manchester, Birmingham, Leeds, Liverpool, Sheffield, Newcastle. Convenience and delivery continue to be a huge part of the F&B market. We experienced high demand from the drive-through sector, which with a lot of the QSR operators and coffee operators and people like Greggs opening more drive-throughs, and this pushed the rents quite high. Not just from the new entrants such as Popeyes, Slims, etc., but also from the older generation of drive-thrus like McDonald's, Five Guys, Burger King and KFC. We also saw TGIs fall into administration, and the Botanist did a CVA as well and disposed some of their sites. Having spoken to a number of the F&B operators we have relationships with, we understand some of them actually achieved record sales during November and December festive periods, with one of them reporting their best sales ever on record in the whole portfolio, but it didn't necessarily translate into profit for them. I thought it'd also be useful from 2024 just to mention some of the corporate deals that we saw. Wingstop, obviously 6th Street acquired a majority stake in Wingstop from Lemon Pepper Holdings for circa 400 million. I know Aids here can probably vouch for that as well. New merch. So yeah, it didn't... There was also Nottingham-based 200 Degrees Coffee, who secured 3 million in funding from the Foresight Group. Blacklock, who a lot of you will know from London, have recently opened their first regional site up in Manchester. We actually acted for them there, and they've recently secured some new investment from BGF, and they're on the hunt for more regional sites. Loungers have obviously been hugely successful in their growth. I think they trade now from about 282 sites. Hooks, you can confirm? 84. They've received an offer from Fortress. Obviously, that's been in the press, so not sure on the latest on that, but hopefully something there. So then I thought it'd also be useful just to go through some of the key openings and deals that happened. Sheffield, the heart of the city development's been ongoing for many years. If you visit now, you will see a huge difference in the city. And the Cambridge Street Collective, which is the food hall at the heart of that development, has really changed the whole dynamic of that development. It's driven footfall really high, strong sales. There's lots more development planned over in Sheffield with the urban splash development of the John Lewis, the former Cole brothers. So that's been a really nicely done food hall. Pasture, the state restaurant who operates in Cardiff and Bristol with their other brands and their other fascias, Parallel and Radius, they've opened in the former Barclays on Colmore Row in Birmingham. I think it's 6,500 square feet, and that looks really good and it's trading well. Flatiron, obviously you'll all know the steak restaurant. They've expanded outside London. They've now got Leeds, Manchester and Cambridge open and all seems to be doing well. Lena Stores opened in South Kensington, and they're also on-site fitting out a huge site in Manchester on Quay Street over near Enterprise and the St Michael's developments, and we think that will be a great addition to the Manchester scene. Cricket opened another site in Canary Wharf, and they've got a regional requirement for Manchester currently. Big Mama Group, who are obviously very acquisitive at the moment, they taking space in St Michael's in Manchester and also in the Paradise development in Birmingham. Blank Street Coffee, they obviously trade from various East Coast locations in America, and they've done 2 in Manchester in 2024 and 1 in the Trafford Centre as well. And finally, the Ivy opened their Castle Street site in Liverpool just before Christmas, and that looks really impressive, and I think that will be a huge success for them. So just moving on to potential challenges the operators are facing this year. There'll be a lot of positives ahead, particularly in the second half of the year, like Simon suggests. But obviously, there's a lot of challenges faced by hospitality. According to UK Hospitality, there's £3.4 billion worth of costs hitting the sector this April, which will threaten businesses' ability to invest and grow. Clearly, the effects of the UK budget and the national insurance contributions rising, the minimum wage increases and the business rates relief cap, which has now been reduced. The sector are hoping the business rates will finally be reformed at some point, but it won't be a quick fix, if at all. Energy costs, we're seeing they are returning to more stable levels for operators, but not where they were sort of pre-pandemic, and I don't think that will change moving forward. We're seeing some suburb sites closing for some operators as local sales may have dropped, but city centres are still thriving and the requirements are still there from demand. We think operator sales will be propped up by price increases being passed to customers due to the cost of operating. Fit-out costs are still high for operators. And I don't think that will change either, especially the amount that they're investing. And with a full-service restaurant, just the M&E and the kitchens cost, sometimes £500,000. Restaurant no-shows, this is still a huge issue for operators, particularly when there's large groups, and it really does impact their labour costs. Most venues do now take deposits, even for smaller groups, just to make sure they can kind of cover some of the costs at least. Obviously, bad weather impacts this, and I know rail strikes in central London have been an issue. So just moving on to the outlook for this year. So we do think independents will continue to expand. We've seen a huge amount of this in Manchester in particular and the regions, and there's lots more planned. They operate from smaller sites. They can be a bit more flexible in their fit-outs and the fit-out costs, and they can basically plan their seating and dining so they can do maybe 2 sittings a day, manage the labour costs accordingly, and there's lots of demand for those brands. There'll be more opportunities with landlords and tenants working together in partnerships with JVs and management agreements, particularly where the operators don't have a lot of finance to roll out and grow. The independent coffee sector has done this for quite some time now with management agreements, particularly on the ground floor of office blocks. And that amenity within residential and office blocks at ground floor is now really at the forefront of discussions with the developers. And a lot of the office tenants are demanding the kind of use they want on that ground floor from F&B and bakeries and cool new restaurants. Incubator spaces and dark kitchens are still used, and I think they will still be, especially in regions for the people coming up from London, perhaps using a delivery sublease in a kitchen and seeing where their data comes from, where the customers are coming from, and if they'll potentially work in that area. I think this is a big one for me in terms of this year, is diversification of portfolios. I think a lot of the casual dining brands, they can reinvest into the portfolio. There'll be significant estate-wide refurbishments and some site disposals, which will obviously bring opportunity for other operators. We've seen Big Table Group rebranding some of their Café Rouge sites to Banana Tree, for example, and it's a good way of them growing quickly and testing that new brand with space they've already got leases on, just to make it quicker, less fees in terms of new acquisition fees, etc. So I think they will look at that and just try and right-size portfolios. Social media. This is just some of the independents in Manchester. So we've seen Kaji, Scarf, Erst, Stowe, Atomica and Schofields all open last year. If you are in Manchester, they are all worth a visit. Social media, it's still significant for hospitality and consumer choices and picking the venues they want to dine at. I think they have basically 5 seconds to capture somebody on social media before you lose them to the next scroll. So brands need to be really creative with this, but it is being really successful and it's driving lots of customers to create queues outside venues and creating hype around new entrants, particularly for the independents. I think special occasion and premium dining will remain successful. Brands such as Ivy and Hawksmoor are still acquiring, and they're still popular venues, certainly in the regions. Franchising, I think that will play a big role for growth with certain brands. Coffee and QSR sectors are still using this to grow further, and we still see there being growth in that fast food QSR market. We've got new entrants like Raising Cane's, the Dave's Hot Chicken, all looking for space currently. Bars, pubs, premium cocktail bars, they're still expanding, whether that's chains or local brands like a Schofield's. And I think local pubs with good food offer will still be popular this year. Lots of leisure and F&B operators are working together more now to partner up, particularly in the leisure space, where they don't want to hone in on the food because it's kind of takes their eye off the ball a bit, so they stick to what they're good at in leisure, and then they'll do the F&B concessions with certain operators. So overall, I think there's a lot of challenges ahead, particularly from April with the NICs. But with this, there will be opportunity, and those well-backed, well-run F&B companies will continue to thrive, particularly in prime city centres and London. Thank you, and I'll pass you over to Nigel.
Thank you, Sammy. That's great. On to leisure. So what are the key themes? All right. Cinema's tumultuous year, but we saw growth in admissions. Big box leisure continuing to expand in the UK and globally. New leisure concepts continue to be rolled out. Immersive galleries and theatres continue to expand. And then health and fitness grows, with particular focus on paddle tennis. To say that cinemas had a lot going on last year is a gross understatement. We started the year with Empire's administration. We acted for the administrators and sold 5 cinemas to Omniplex, 2 Tivoli cinemas to Everyman, and of the cinemas that went back to landlords, View picked up Swindon and Basildon, Odeon picked up Peterborough. Over the summer, we then had Cineworld's Section 26A company restructure. Approved in September, rent cuts were imposed on landlords if you weren't a Cat A cinema, And while the restructure is still working its way through, it looks like 11 cinemas are closing, leaving Cineworld with an estate of 90-odd cinemas. View picked up Castleford and Nottingham and Poole, while Odeon have taken on Middlesbrough and Northampton. Then in July, Sundance agreed a $2 billion merger with Paramount. That's Showcase Cinema's parent company, leaving the market eager to know what will happen to Showcase Cinemas in this new media company, whose core business is not cinemas. And then in October, The Light, who operate 13 cinemas, were bought by Luke Johnson's Risk Capital Partners. He also has stakes in All Star Lanes, the Brighton Pier Group, and Draft House. The good news is he's injecting £15 million of capital to help finance new openings for this new combined cinema and FEC format that has been rolling out. And then to finish the year, as if we didn't have enough already, in November, Curzon, who operates 16 cinemas, was sold by Cohen Media, who got into financial problems, to Fortress Investment Group. Despite all this confusion and corporate activity, the stronger operators have continued to trade well and open new sites. Everyman opened Cambridge on top of Cheltenham and Bath. Odeon opened Peterborough, and View opened in Europe, in Amsterdam, and Basildon, with Swindon due to open soon. These groups are investing in their estates, refurbishing cinemas with the latest seats, sound, and tech, usually linked to re-gears, so the quality of their cinema estate continues to improve, and they ensure they are the go-to cinema for any given catchment. With regard to trade, 24 actually did see cinemas repeat Barbieheimer, with Paddington, Wicked, and Moana 2 in the last quarter of the year. Admissions grew to 126.5 million, and box office achieved over $1 billion, slightly up on last year. The cinema industry remains dependent on film content, the top 10 films contributing over 40% of box office, which is what happened last year as well. And we ended the year with some great film releases. And then the film slate for 2025 is looking good, 2026 even better. Look out for Mission Impossible. Does anyone know what number we're up to now? It's 8. Talking about cinemas, I would be remiss not to mention and remember Kevin Frost, who sadly passed away in November. A long-time member of the LPF and known to most of us in this room, instrumental in restructuring Cineworld and an advocate for the leisure industry. He will be missed. Moving on to big box family leisure. That had a busy year and continues to provide landlords with a solution to their surplus retail floor space, while also delivering valuable customers to their centres. Bowling remains as strong as ever. Hollywood Bowl opened 4 new sites, Westwood Cross and Thanet, where we put them into a former Debenhams, their most successful opening ever, I'm told. They also opened in Colchester, Maryhill and Swindon, and these last 2 sites, both repurposed retail units. There's a theme there with leisure. Lane 7 opened 140,000 square foot of space in 7 sites last year, including Camden and on the continent in Berlin. Gravity Max opened Stratford City, with more in the pipeline. Super Bowl opened Aldershot. Fun Station opened Odyssey Belfast, with further plans for their Volcano Falls Crazy Golf brand this year. I see a similar level of activity in 2025 as FEC operators refine their trading propositions, ensuring that they interchange different activities for the latest craze to keep customers engaged and coming back for more. Moving on to the competitive socializing sector. That's experienced unparalleled growth over the last 5 years, soaking up again surplus retail space. And for most landlords, operating like mini anchors as they drive so many customer visits. Activities include golf, bowling, darts, VR, and now football, fairground games, and arcades. Expansion has been in London, the regions, and internationally. We did a deal with the Flight Club to open on the roof terrace at Westgate, Oxford. They now have 10 sites in the US and 4 in Australia. Fair Game will be opening their second London site in One New Change this year. Bat and Ball have signed on the old Belgo in Covent Garden. UK companies are expanding abroad as well. Formula One Arcade are opening Las Vegas this year, which means they now have 5 sites in the US. Lane 7 opened Berlin, as I've already mentioned, and are opening 2 sites in Ireland this year, with further sites planned in Europe. In fact, the reason they're not here today is they're touring around Europe. TOCA were at MAPIC last year, promoting expansion into Europe as well. There is also US companies coming in to the UK, like 5 Iron, who my colleague Piers Finlay is acquiring for, and COSM. And then on to new concepts. Well, these are being rolled out all the time. Just listing a few, there were too many to put on one slide, including Busy Me, the new children's activity centre. We've put into Battersea Power Station, 13,000 square foot. Little Lion keep developing new concepts from the original Crystal Maze, which now has a smaller regional version of 7,000 square foot and looking at space. Chaos Carts, and their new games arena, both requirements of 25,000 square foot. Activate, the immersive interactive game concept from We Are Play, opened 10,000 square foot at the end of last year in the O2. We've been there and tried it, and it's great fun. I recommend it. Gravity opened their first Gravity Arcade in Bluewater just before Christmas, and it is trading really well. And Level Up from Lane 7 has 2 sites agreed, and I'm negotiating several more to open this year. Immersive galleries and theatre. Well, developments in technology mean that museums can easily now go on tour. Frameless operate from Marble Arch, blending a fusion of art and entertainment. The market has been dominated by the larger international players, Team Lab and Meow Wolf, but with requirements from Flying Theatre, Wake the Tiger, a UK brand, Netflix, Moment Factory, Guinness World Records, there'll be a lot more activity in this space this year. I need to congratulate Phantom Peak, who actually I put into Hawker House in Canada Water on a short-term let a few years ago. They've created an amazing immersive town there. If you've not visited, I'd recommend it. And keep on winning numerous awards during the course of 2024 for being the top immersive experience in the world. Sadly, we are going to redevelop, or that site is being redeveloped, so by the end of this year, there'll be a new 30,000 square foot requirement washing around. Finally, the health and fitness market continues to be dominated by the gym and Pure Gym. In 2023, combined, they acquired 26 sites between them. In 2024, Pure Gym alone did a record 44 new sites. It helped that we acted for the administrator of Carpetright and sold 22 sites to them. But they still intend to roll out 66 sites this year and do the same number next year. This is forcing them to lead to more flexibility in their requirements. So the unit size format has gone down to 5,000 square foot now. So their requirements anywhere between 5,000 and 20,000 square foot. In contrast, there is limited growth in the boutique market. Although I did put one Rebel into Olympia London, but generally expansion is very quiet with F45 out of the market. The luxury operators, Third Space, are still looking for sites, and David Lloyd opened 2 sites last year, Bury St Edmunds and Rugby, and are planning 5 new openings for this year. And then I've got to mention paddle tennis. It remains the fastest growing sport in the world. The UK has 14 operators, all competing for sites of between 15,000 and 43,000 square foot, depending on the number of courts you put in, and need a minimum of 8 meters clear height. Rocket Paddle opened in Ilford last year with 11 courts. That's London's largest club. While there's a long lead-in time for these clubs, there is no sign of this market slowing. So just in summary, the outlook for 2025. UK leisure brands continue to expand both in the UK, despite some of the cost headwinds we're talking about, and globally. There will be continued recovery in the cinema market. The 2025 slate is good. The 2026 slate is even better. Technology will continue to influence the rollout of new leisure content. App development will reduce operating costs, and operators are going to experiment with self-service options, which happens in the retail world. IP leisure will expand into the regions. Paddle will continue to be the fastest growing sport in the world. And for landlords, placemaking will focus on creating memorable experiences that cannot be replicated online, and leisure is a key element of that. Thanks.
Thank you. Graveyard shift, I feel. Eddie George, Montague Evans, where the team have been involved with a vast amount of traditional, I would say, cinema-anchored leisure schemes all the way through our careers for over 25 years. I hope to keep you all riveted. It's not as depressing a year as we've seen in others in terms of overall content and delivery of investments. A few sort of broad facts. Facts aren't always accurate, as we know, but overall there's been a reasonable amount of investment in Q1, principally driven from slightly hangover deals from 23. Meridian Leisure Park Leicester did very well in the market, purchased just over the line of the December quarter date 23 into 24, and this was followed by a few other schemes that we'll come to in Edinburgh, but then a bit of a hiatus of not much activity at all. Limited activity until Q4. Again, we'll come to that. But overall, the total number of transactions, I'm very pleased to say, in that traditional sector of cinema-anchored leisure schemes has been the first year of a significant increase, over 300 million. And that's been in decline since 2016. So quite a significant year for the landlords and everybody else in this room involved. Total returns from leisure sector in Q2 returned to positive. This had 6 quarters of negative growth before, negative returns. Investor sentiment and the buyer pool, it's been pretty opaque for some times. We've debated whether we leave the UK institutions on this list, but on balance, the UK institutions are still interested in the sector. There is definite interest in the sector from that core group of buyers, albeit there's very limited approach in them buying for the last 5 years. Middle Eastern European investors are still there. Private investors, propcos, high net worth individuals, and private equity remain very interested in the sector. This prolonged uncertainty over the cinema market has caused a lot of the problems. There is no hiding about it. Debt. Not sure there's any finance people here at the moment in the room, but consulting various others, BBS Capital, there is definite debt in the market. It clearly depends on scheme by scheme fundamentals, and indeed the sponsor, what their portfolio looks at, and indeed the amount of debt. But overall, the debt levels are up to 50-55%, and all-in cost are probably somewhere between 7.25% and 7.75% to 8%, depending on the scheme. But that's a positive, because lots of people think there's no debt in leisure, and it's not true. The occupational market, as we've heard, is pretty positive. There's not a huge amount of negativity out there, save as for the cinema market, which is obviously in a large increase. Prime leisure parks, this is the gap. We've looked at this before with various other presentations. There is a significant gap between retail warehousing, where it used to track with probably about 50 to 100 basis points, and it's probably at its widest gap for now. Sentiment. You've seen some of these, so we won't dwell on it. Private equity, David Lloyd, bowling, particularly Hollywood Bowl. There's a lot of good stories, that impact some of the negative sentiment that a lot of our investors read about, hear about, and deal with day in, day out, because Most of the estates are dealt with by the REITs and the institutional investors that we speak to. But I'm sure you can resonate with most of that. The next slide I thought would be quite useful to just recap on liquidity, what investors are looking at. They've got a lot of dislocation in their own portfolios. The office market is so much of a bigger problem than the leisure sector will ever be. Shopping centres have proven that before. They own really good leisure schemes. They have invested them, some more than others. But fundamentally, their choice to invest in leisure and refit pretty good cinemas is questionable. Some are doing it, some are investing for the long-term future, but the impact on improved value is obviously reduced quite significantly with a change in yield. Once upon a time, a refitted longer lease to a cinema, you could easily increase your yield by 100 to 200 basis points, depending on where. That's no longer the case for the time being. But fundamentals, strengths, weaknesses, opportunities, threats, I know it's pretty traditional, but they all speak volumes of the sector. Large, flexible, freehold sites, free parking, accessible land, strategic land in some locations, better AUV in some locations, very low vacancy rates. Some of the most well-managed estates are 100% let, and that is set to continue given the activity in the market. Overall, the weaknesses, we know, aging estates in part, but not all. Poor ESG credentials in part, but not all. Refurbishment costs of cinemas, upwards of £3-4 million for larger cinemas. Who's going to pay for it? The landlord? They haven't got endless amounts of money to invest. There needs to be a cohesion between operators and landlords to both invest in their estates. Hopefully not to offend too many people in the room, but there are outdated food concepts on leisure parks traditionally. It's not all like Manchester on the traditional windswept leisure parks of, I won't mention some parks because I really will offend people, but it's challenging. It's challenging. Highly leveraged cinema covenants, we don't need to go through that. We know where the problems are, but fundamentally, you know, things are looking better. The opportunity for box office revenues to increase and allow those operators to invest in their own real estate, not to say that they're not already, but even more, is set to continue, which is really exciting, really exciting. Private equity interest, as we've seen, is there and will continue to be there. Repositioning of schemes, in part, we really haven't seen a lot of that. Swindon is going to be a very interesting example, and we've seen schemes like Hengrove, we've seen the odd showcase, I think it's Dartford, being bought by industrial specialists, but there really isn't a lot of examples of those traditional leisure schemes being redeveloped into another value add position. So the threats, restructuring, the impact on the other cinema operators, sensitivity of the leisure sector and declining discretionary spend, disproportionate impact of the recent budget that we've heard about already. I do include this because I've always gone on about it, and it is the councils, and we do a lot of council work at Montague Evans, but giving planning permissions and pretty much free sites to some cinema operators in town centres is killing the traditional out-of-town park by taking a part of a ever reducing until recently cinema share of admissions. Restructures, the impact on ERVs is inevitable. The actual position of ERVs is a great debate, because whenever we're looking at a leisure park, some of the yields that we'll put up, they're broadly rented apart from the cinema, and people's perception of a cinema ERV varies quite considerably. Anyway, the value destruction side, it's not all that bad, and leisure sector returns are looking better than they were. So I don't want to baffle you with this. Our research chap has put these in, and what it's trying to show you is that leisure is on the improvement curve. It's looking better compared to some other sectors which have been equally dislocated. So with that, over the past few quarters, capital losses have reduced. This just goes in a bit more detail, comparing it to other property sectors. And as it says, the total leisure returns at 4.2. This is broader leisure, as we're speaking now, were higher than retail, just behind office or offices, and just behind industrial, which is quite remarkable given where we've been over the past 3 years. Probably the most important slide to us, as I've mentioned already, is this gap between prime retail warehousing yields and leisure yields. They all occupy the same sort of space. Once upon a time, well, selectively, some of the leisure covenants are stronger than retail covenants. But as we know, the cinema operators are holding it back, and unfortunately, leisure yields have slipped to at least 8%. And these are equivalent yields, not initial yields, which to some in the room makes quite a difference, depending on your view of the cinema rent. But that gap has widened, continues to widen. Is it settling down this year? We shall see. This is also an important one. Value decline in terms of transactions all the way through from 2016. There was, I think, an average of about 500 million being traded for a very long period of time, and it's decreased. But as we said, last year we're taking a total of traditional cinema-anchored schemes to about 300, or in excess of 300, and that does include health and fitness, of which there were 2, if not 3, David Lloyds, which are fairly significant lot sizes, and in their own right, managed to convert at a sort of mid-fives net initial yield. So I thought, again, some debate in the office, how many are we going to put on here? It keeps everybody interested. Hopefully many of you in the room are linked to some of these schemes in some shape or form. So I'm going to canter through. Leicester was Legal and General Leisure Fund, incredibly well managed, 20-acre estate, 14 years unexpired, 50% fixed uplifts, a cracking deal, I would say, for the landlord to sell that at 8.5% back at the beginning of last year. Old Dairy, South Ruislip followed afterwards. A really struggling sale, value erosion from a retail fund at Aberdeen, but it was a motivated vendor, so they were always going to get to a price that matched the market and liquidity at that point in time. Montaigne Partners in a JV. I would add, though, that despite it being South Ruislip and 18 years indexation, most of the value was attributable to ASDA, which wasn't the most easiest covenant to fund at the time. A few more. Omni Edinburgh, cracking scheme, cracking city. Ended up being a rather family office, I think, based in Switzerland. A pretty impressive yield, but a pretty impressive scheme with a lot of fixed uplifts, a lot of car park income, a lot of hotel income. Trowbridge, less well known to me personally, but I have been to Trowbridge. But that was the problem, Trowbridge. Investors in a very poor market. Where on earth is Trowbridge? I won't say anything more about Trowbridge. I might offend people. Yeah, Aroco Zen. Has anybody heard of Aroco Zen? Nope. They're a French REIT or equivalent. And oh, okay. Thank you, Dave. Yeah. Well, anyway, it's a fairly clean scheme, and it's a fairly new scheme. 60% fixed uplifts, Odeon covenant, but 30% of the income was Premier Inn. To continue, another fantastic scheme. Have to say that because we were involved with the original purchase. But wow, haven't L&G done a fantastic job to keep a incredibly large scheme. I think it's over 300,000 square feet. Prime city centre, Leeds, 0% vacancy. I think that's right, Fergs, isn't it? Pretty much. 78% of the income's indexed. It was a transfer, which you can all take a sigh to, perhaps, but valuers are involved. And that was a transfer from a 50% ownership from the leisure fund to the managed fund. Isle of Wight, forced to mention the Isle of Wight for good reason. The first transaction post-Cine UK restructuring. So congratulations. Hopefully there'll be another one in Rochester very soon. And Rochester, another favourite of mine, sadly not buying it, or indeed selling it. But 20 acres of the River Medway, depending on your view of flood risk and alternative use value. I hope that hasn't had an impact. is 10 years of income, 44% indexed, and 30% Premier Inn. So if you strip out the Premier Inn, the overall yields in double digits, like it is in most schemes. And it will be a very important deal. It is in the southeast, but that city UK will need a lot of investment. So let's hope the buyer has deep pockets. A much cleaner scheme and a much more invested scheme is Freeman's Leisure Park, Leicester. A very, very clean Odeon, a very impressive trading statistics. In fact, the whole of Leicester, there's a lot of people in Leicester that go to the cinema and share those admissions between 3 cinemas. But a very clean scheme, which is under offer. And hopefully that will go through and present both of these to the market for next year's presentation as some cracking starts to 2025. Available, I really will canter through this now as you're itching for a drink. Kingston upon Thames. I'd be wrong not to mention this. You mentioned Leeds. Kingston is a phenomenal retailing southeast town. You need a motivated seller in this market. Tritax are less motivated than others. Perhaps the Odeon rent and opinion of ERV was hampering that sale. But Toby's glaring at me, so I think I'll move on to Gallagher Leisure Park, Bradford. This is one that's close to us, actually, and there's probably some others in this room, but a very simple scheme, another example of where Odeon and the landlord Threadneedle invested quite a lot of money into that scheme. It's very simple with a gym and a couple of drive-throughs, but unfortunately we didn't quite get there, and nor did others, and it's back in the box. But again, it's a demonstration of a motivated vendor. It's a retail fund, and if the pressure goes off, they don't need to sell. And this comes back to motivated sellers. There's a lot of landlords in this room, probably not enough, but if we're bottom of the curve, then if you don't want to sell, you probably shouldn't sell. Or if you don't have to sell, you shouldn't sell. And finally, Star City, Birmingham. A phenomenal scheme, phenomenal trouble perhaps, but it's one man's full-time job or lady. There's a lot of asset management, and I'm sure lots of you have been involved in some shape or form. But I think the current price is still 50 million, and it's still 11%. We'll see how it goes, but again, you've got a motivated private equity seller, and the rumours are that it's close to going under offer. Broad Street Plaza, Halifax, again, another motivated seller, a REIT, and that should probably go later this year, probably in the mid-teens. Outlook for 2025. Debt availability is expected to remain a challenge. It is a challenge, but it really depends on who you are, what else you've got, and the type of scheme, as we discussed already. But it yields in double digit. No matter what your view of ERV is, there is debt available, and you can really make the numbers work for all types of investors. The caution is still going to be there until the cinemas really sort themselves out, and ideally probably have three years of clean trade and upward trade to try and diffuse some of the debt that's in their covenants. It's going to take time, but the short to medium term, at least, is going to remain a very cautious market. Investor range, we've already touched upon. That's probably set to continue throughout the whole of 25, but we have liquidity, and it's been proven. Income and capital growth prospects remain strong against other challenged sectors. Box office, all the statistics are proving positive, so let's focus on that. And the growth in spending on eating is expected to exceed average consumer spend. I didn't quite believe that when I first read it, but apparently it is true. So on that positive note, I will leave you, and we'll go back to the Q&A.
So Simon, if I could start with you. You gave us a really good, clear picture of what you think is going to come and where the impact has been on the macro climate. What advice would you give leisure operators about the impact on consumer spend over this year?
Yeah, so I think the bit that is missed really in understanding the UK consumer is actually what has held the top end of consumer spending down. Actually, not just since the pandemic, but arguably since 2008, there's been a steady deleveraging cycle. They've actually got far less debt than they had in 2008, the consumer sector. And as I showed on the chart, they have far more cash. But the degree that we can understand the consumer behaviour, and by the way, the ONS are not certain, I'm not certain, most economists are unsure on this, but the degree we can, if you like, find a common thread in why they are not showing those animal spirits, it's fatigue of crisis fatigue, Brexit, the pandemic, the mini budget, the most recent budget, events, two globally significant wars. There's a lot of reasons the consumers are going, rainy day funds need to be topped up, appetite to take on leverage. But there is always the other side of that coin, which is that caution is rebuilding the overall strength as and when those animal spirits return, which is why, and I'll finish here, the budget has been so frustrating, not so much the policy, but the whole framing was, as I said in my presentation, if you wanted a case study on how to dampen animal spirits, all the rhetoric around it did precisely that. And that's the big imponderable, really, in my forecast, is whether a more stable backdrop, Trump has promised to finish these wars pretty quickly. There will be clarity on those spending plans from the government, whether that will generate the animal spirits. If they will, the UK consumer and leisure sector is a really, really good place to be.
That's really interesting, because the other part of the coin is not only the spend coming into the sector, but how operators are working on their cost basis. Sammy, you talked to us earlier about how restaurants are budgeting for things like refurbing and fitting out and the energy costs that it just goes on to the bottom line. What are you seeing on the ground?
Well, if they make the sales are higher, like the sales are performing, but it just wipes out the bottom line. And what's key for the operators at the moment is the NI contributions. They're not just for full-time staff. They're going to affect those part-time and flexible staff, and that really is going to hurt them. So any profit they did have with all the, the cost of everything else and service charges, things like that, it just wipes out their bottom line and the profit. So I think that, it is going to be difficult for them. But then all that means is when you're running the appraisals to see what rent affordability they have, that's treated, as a cost, but then you've got to factor that in somewhere. You can't change the service charge, you can't change the fit out cost, you can't change the energy cost. So that comes then off the rent. So then it hurts landlords on the other side. So it's just about working together, I think, really, this year.
It's a really difficult balance, isn't it?
Yeah.
And when you talk to us about operators looking to refresh their existing estate, are they doing that instead of opening new stores, do you think?
Some of them have been. I'd say sort of some of the larger chains last year in particular were investing in the refurbs and refreshing, because whilst there's a lot more competition coming in, they've still got to keep up with it. So if they've got tired looking stores and restaurants, then obviously that's where the competitive edge comes in from others. So they do need to do that as part of the normal course of looking after their estate and managing it well. But I think some of them have sat on it and not acquired, and then others are now doing that to then go back to the market and launch with a fresh look and feel.
Yeah. And Nigel, we've been talking about the payroll being a massive part of the cost basis, both in hospitality and leisure sector. Are you seeing innovation coming to the fore to help reduce this part of the cost basis?
Yeah, absolutely. Just on a down note, when we talk about costs, it's worthwhile remembering that the minimum wage, when it comes in for operators, doesn't just affect people on minimum wage. Actually, wages across the whole company go up. So suddenly, a lot of these leisure companies have got bills of £1 million that they weren't planning for. So that that drives innovation as a result. So yeah, I would say that technology is a big one. App development, I mean, you probably saw it best, or probably everyone will have experienced it best in the cinema world. Well, now you don't have a ticket office when you go to a cinema any longer. You buy your cinema ticket on an app. You actually buy your popcorn, ice cream, and drink on an app. You get out of the car and you press send, and you walk into the cinema. You show your barcode, and you pick up your drinks and go into the cinema. So that's an enormous cost saving on staff, sadly, because we want people working in this industry, but it is a cost saving, and that is being rolled out across all leisure operators. So the big family leisure is doing it as well. You'll also see it, and there are one or two trialing it, and I imagine it'll grow more and more. I mentioned in the talk self-service options, which you see in retail, you see in grocery stores. All operators will be rolling that out as well.
Yeah, it's that convenience, and actually the younger generation is just so native with it, fluent on screens, and I certainly am not yet. And Sammy, looking at innovation, you talked in your presentation around delivery and the data that part of hospitality can give the operator in terms of understanding their customer better and the data they get from the third-party booking systems. How are operators using that in a property perspective?
I think if they're new entrants to areas, they can see where all their, say, Deliveroo, they can see where that's coming from, so they can see which specific areas of a city or the edges they should locate in. So it does give them that data, but also the bookings, because then they can do the targeted marketing and emails and, you know, offers, then the loyalty schemes and everything else they offer. So they've got so much access now to that data. You know, every day you get so much email traffic from a restaurant you might have been to. So I think it does work for them if it's done in the right way.
Yeah, you can kind of heat map, can't you?
Yeah, you can. And even some of the research that operators are getting done for their growth strategies and reports, you know, they've got the credit card data, the spend and all of that, and they can see that the hot maps and, you know, to the point they're getting so granular, you can see the street, which is purple, is like the hottest street, and that's where they should locate. So then it lets them canvas options for sites and things.
Yeah. It does make location finding so much easier.
Yeah, if they're really strategic about it, they can get the best site with the best spend, and you know, as long as the concept's good. So
yeah. We've talked a fair bit today about the corporate restructuring, and I'd love to. And you know, there's been news today of another administration, so it would just be really good to hear from any of you. Eddie, I don't know if you wanted to talk about what you think is going to happen this year in terms of corporate restructuring, or is Nigel better placed?
Nigel is definitely a better place.
We've done it all. We're fine now. Yeah, I mean, obviously, people are going to be asking about the cinema industry again.
Yeah.
We, as I say, we had a torrid year last year, but actually, we got through it pretty well. I think you know, Odeon and View have done a great job in trading through, you know, COVID, through directors' strikes, lack of content, and they are still driving some great numbers through their cinemas. And the consumer loves visiting cinemas. Let's wait and see how Cineworld get through this year. Obviously, they've got through the restructure well. They need to invest in their estate. Otherwise, I think generally there are always car crashes in the restaurant world, but the leisure world is pretty well placed at the moment.
And does the restructure provide them with the capital to invest back?
Yeah,
in?
it does. So they've set aside quite a few millions to reinvest in the estate. Yeah, and we need it. As I say, the consumer is not 100% loyal to a cinema brand, but certainly if you have the latest seating, the best sound, and you're convenient to visit, the consumer goes there. And that's where Odeon and View and others have done so well, during Cineworld's problems because they've been stealing market share off them.
What is the correlation between the experience and the price in it, for the cinema then? Where do you think that tipping point is?
We really need to. Is Dave here? We need a few cinema operators speaking. But yeah, I mean, I think what they have realised is that just going big and full price is not the right way of doing it. So smart pricing is certainly where View go. Odeon do it as well. So you actually have different prices for different parts of the day. And then demand for screens. You will pay full price on the day of a release.
Yeah, that makes sense.
Yeah.
Yeah. And Sammy, what are you seeing coming over the hill in the hospitality sector in terms of restructure? Do you think this year is going to be an active year?
I think we might see some formal restructures with CVAs and admins potentially, but I think a lot of them will diversify the portfolios themselves. In an ideal world, they'll do some disposals, whether that's off market or in the market, and just try and get rid of those non-profitable sites so that we're in a good shape for acquiring again.
Great. What I was really comforted about is the in your presentation this real understanding of growth across the country. We're not just seeing growth in hospitality in London and the South East. That Manchester and Leeds and Liverpool are all showing some really great stats in terms of...
Yeah, they are. They've been really. It's been really positive regionally, actually, in the last year, and there's still huge demand again for the city centres. Manchester in particular. I know I keep going on about it, but Birmingham in theory is like the second city with catchment and stuff. But Manchester is seen by a lot of the international operators as a place they want to be, and with the developments like St Michael's, you've got Soho House coming this year finally. There's talks of big international brands coming and developments like Enterprise, and St Michael's is fully pre-let on the office side and the F&B and the residential sold at record rents. So yeah, the city's, expanding constantly with the residential development. So there's loads of positives, but, we're also doing things in Sunderland, and that's really turning a corner now with the council's investment. Sheffield, as I mentioned, Liverpool, obviously, Liverpool One's always got requirements. So it's been a really positive sector for the regions, I think.
That's fantastic. We heard a bit about UK leisure brands expanding abroad, but we're also seeing brands from abroad coming here. How is that impacting? Can that just be a good thing for the market?
Yeah, it was a great thing for London. Generally, when international brands come to the UK, certainly from the States, they focus on London first. As anyone knows, bringing an international brand into the UK, they love to visit, and then when you start going through the costs, they are petrified. But they're coming. We all go out to MAPIC every year. I talk European brands to open up in the UK, and they are doing that. I mentioned Five Iron, who we acquire for, so that's a US brand coming into the leisure market, looking for 15,000 square foot. The one I'm really excited by is Cosm, trade in LA, and their requirement will be for 80,000 square foot, but yes, it will be London focused.
Great. And just finally on kind of that leisure growth, you mentioned paddle, which is really exciting when planning allows it to be built, which we're struggling with. But I wondered if there were any other kind of trends that you're seeing, maybe in the health and well-being sector, that you can see some. What should we be keeping our eye on? Is saunas going to be the next big thing?
So the short answer is yes. There's a plethora of things. I mean, going back to paddle, what's interesting is that a lot of requirements, a lot of demand and competition for space. But you're absolutely right. Planning, fire escapes. The joy of that requirement is that they can go indoor, outdoor, you can stick them on a car park, but they take a long time from initial meetings to actually getting a deal done and them opening. What they are finding is that where they started off at a very low rent, because of the competition, they are changing their model. So it was pay and play. They're now looking at membership and pay and play, so the rents there are going up. I'm not an expert in it, but High Rocks as a gym concept, most gym operators are putting that into their space. I imagine that might become a standalone offer as well.
Yeah.
But not my expertise. You're nodding your head, so you must have done it.
I've not done it. Absolutely not done it. No, I think, Alice, there's lots of the ice baths and saunas and things coming in as well, and lots of talk of pickleball. I don't know the difference with that and paddle, but I'm sure some of you do. And the cryo chambers, reformer Pilates, and the hyperbaric chambers now are kind of rolling out some sites, and which is all these oxygen chambers and things for well-being. So I think there will be a lot on that health side.
Great, thank you. So Eddie, just coming back to the leisure sector and the development, what we saw in your presentation today was developments really from the 1990s and 2000s. Previous shopping centre owners and residential developers have been building leisure as part of their development or refurbishments. But given the historic low levels of leisure values, do you expect this to continue, or do we need value growth to restart the development in leisure?
Well, leisure in the traditional sense, as I call it, cinema anchored schemes, no. I think arguably the cinemas have reached saturation level, but that's not my area of true expertise. But no, the numbers just don't work, and they're not going to work for a very long time. What we're going to see is hopefully a lot of investment from landlords and operators to refurbish existing schemes, make them better, make them more relevant, and future-proof. That's where the development comes from. Obviously, shopping centres is another dynamic. Town centres, that is a form of development, but it's not new development per se.
Got you.
Is
Lovely.
my view.
Right. Oh,
So I was just going to chip in.
Start thinking, everybody. I'm coming out to you after Nigel's spoken.
Only in defence of leisure that doesn't pay big rent. So we have over the years seen a transition of leisure operators beginning to pay bigger rents. That is predominantly around operators who are able to trade morning, all the day parts, and into the evening. That's great, because what we're finding, and when you start analysing it, is that, and I mentioned mini anchors in my presentation. Actually, historically, we looked at cinemas as our anchor, delivering 400, 500,000 visitors a year. In reality, we're finding that competitive socialising, big box leisure, is able to deliver the same sort of numbers now. And as a result, you want to look at our various estates with regard to mini anchors. Retailers had to do that for years with the demise of the department store. So I would encourage that. At the same time, there is some leisure that will never be able to afford big rents, soft play, young family leisure. So in defence of that industry, I would say landlords do need to factor in cheaper rents in some locations.
Yes, absolutely. Okay. Who has a question? Great. Could you say who the question is for?
Hello, this is a macroeconomic question, so anyone can take it. So on the options available to the government, if the bond yields remain high, what is the expiry profile of that gilt maturity profile look like, and how likely is it, do you think, that they'll stop?
Yeah, so it's a good question. For those not familiar with the question or the premise for the question, the Bank of England, since 2009, bought over £900 billion of government debt in a process called quantitative easing, and at one point owned about a third of UK government debt, all designed to compress yields, loosen financing conditions because of the very slow recovery from the from the global financial crisis, and of course after the pandemic, when about half those purchases took place. I think if I understood the question correctly, you're talking about what is in effect the rolling off reduction of that amount of debt, which has already gone down by about 150 billion, is expected to go down by another 100 billion pounds this year. Now, about 87 billion of that, so the lion's share, is just gilts maturing. So they mature and the Bank of England doesn't buy any more, so the residual issuance, because the government's still running a deficit, get issued to the private sector. But there's 13 billion pounds of that which they sell to hit their 100 billion pound target, and because debt is considerably higher yields now and lower prices than when they bought it, that incurs a loss for every single person in this room. Those were gilts bought in your name by the Bank of England, which when they make a loss on, it wasn't actually Eddie George, it was actually Mervyn King, another Bank of England governor, who negotiated with the late Alistair Darling the terms of quantitative easing where the Treasury, so you and me, cover any losses. Now, this was an immensely profitable exercise during quantitative easing because bond prices just went up and yields went down, and they made about 120 billion pounds for us all. And now they're losing money at a rate of about 40 billion pounds a year. This year will actually be relatively small losses because less active sales, but actually if they keep going for the next few years, you're probably talking of a liability of up to 200 billion pounds for the taxpayer over the lifetime of getting rid of the government, of the Bank of England owning debt. Now, I wrote my Times column a week and a half ago on this subject, suggesting that the Bank of England should stop that and just say, right, look, financing costs for the real economy at a time when they're trying to absorb all these other costs, just it's layering on unnecessary pain. Andrew Bailey hasn't listened thus far. Let's see whether he listens a bit further in the coming weeks.
Thank you, Simon.
Thank you. Post-COVID, there was obviously an enormous shift in working patterns where huge numbers of people were working from home and going in the office a lot less than they used to before the pandemic. And that had a big impact on market towns in terms of F&B. We've heard in the last few weeks people like Stuart Rose, Boots coming out saying that they want to see everybody back in the office working normally again. So does the panel think that we've reached the high water mark for market towns and that the safe place to invest going forwards is back in city centres?
Sammy, do you want to take that one?
I think it depends where, Simon, in terms of which market towns, because you've still got Cheshire suburbs, for example, and things like that, or, you know, down south as well, where they're still really busy, really affluent, and you'll still see spend there. City centres, of course, they've got more footfall. It is definitely on the up and it's coming back, but you're also, coupled with that, you've got a lot of resi in the cities now. Like that is growing even more than it was. So that's coming online. There's developments everywhere in the city centre. So I think that's obviously adding to that midweek spend as well. So, yeah, I think it just depends, to be honest, where it is.
I also think, I don't know if anyone wants to take the slide away, I certainly do. I thought the best slide of this evening was Simon's slide showing how wealthy we all are. and the reality is we all want to eat out more. So I don't think market towns are going to suffer. If anything, my wife included, we go out more than we ever did before.
Thank you.
Just on the behavioural point, I think we're well past peak remote working, and I think the screw will tighten further now from employers, and actually the weakness in the labour market that we're starting to see will only accelerate that process. People don't like a presenteeism culture, but when they think their job is at risk, they will quickly revert to that as a tactic.
Great, thank you. We have a question over here.
Yeah, I wanted to ask the panel about picking up perhaps Nigel's point, talking about rent, and if rent is a proxy for shortage of space. In particular, I want to ask the panel, perhaps the two agents, and then maybe Eddie for good measure, but where they're seeing the most demand in terms of space and where that might result in rent starting to go up rather than the trend that we have seen, which has been falling.
Well, I'm holding the mic, so I'll kick off. Value gyms. The growth in demand for space there is phenomenal. I'm going to be vague, but I'll give you a suburb of London, 15,000 square foot. Starting rents started at £25 a square foot. They got well in excess of 30 quid just through competition. Sam, you probably commented on as well, the quick service restaurant market, particularly that chicken menu offer. There are a lot of operators competing for space, so inevitably landlords are going to say, well, what differentiates them? Hopefully they look at menu, who the consumer is that visits, but rent plays in a big part in that as well.
Yeah, I agree with Nigel on that. We're also seeing it in that restaurant footprint of sort of 3,000 to 4,500 square feet as well. When there's lots of demand, we're seeing a lot of demand from the London operators who want to do their first outside London, perhaps in one of the regional cities, because it's a cheaper entry into those regional cities, so they can afford to pay a little bit more, assuming the sales are there. So as long as it's a prime location, if there's competitive demand for it in that size space, that's the hardest requirement at the moment, I think we're seeing.
I can take one more question if anyone has one. Oh, lovely.
One subsector we haven't talked about is pubs and bars. On the one hand, I'm reading that people, especially young people, don't drink much anymore. On the other hand, the Gen Z are drinking all the Guinness. So I just wondered what the panel thinks about the outlook for pubs from a consumer point of view and also from a corporate growth point of view.
I think there will still be demand from pubs. They're going to be hit with big costs, especially the larger chains. I know, I think it was Green King or one of them came out and talked about, you know, the national insurance contributions and how big that effect will have on them with all the staff and the part-time staff. But I am still seeing pubs acquire and also sort of premium pubs and cocktail bars. There's lots of cocktail bars popping up, and I think they will still acquire. And local, you know, country pubs with really good food offer, we're seeing a lot of them still opening and trading well. Don't know if you want to add.
I was just going to comment, what a genius bit of marketing. Yeah. Before Christmas, we might not have enough Guinness to go around.
From a macroeconomic standpoint, one of the interesting trends, and this is just the UK, but globally, was during the pandemic, people overconsumed around the world consumer goods because they couldn't go out. They couldn't go to pubs, they couldn't go to restaurants, they couldn't travel, they couldn't go to cinemas in large part. And therefore, what happened was an overconsumption of consumer goods. It was why global supply chains became so inflationary, so stressed, because largely China were shipping huge quantities of soft furnishings, if Mrs. French is anything to go by, around the world to satisfy this demand. I always make jokes at her expense. It's not fair. She's not here to defend herself. But there was therefore an air pocket as the economies reopened, which was pretty predictable, that there would be an underconsumption of goods, clothes, soft furnishings, and people wanted to go back and experience, you know, hospitality, leisure, social events, travel. What is far less clear is now, you know, we are in large part 3 to 4 years on, whether that air pocket has evaporated or whether it's a new normal. And I think it's probably one of the biggest questions that has really misled economists around the world, is that the manufacturing sector making these goods has been in a recession for 2 years. If you look at global purchasing managers indices, they tell you the world's economy has been in a recession for 2 years if you just looked at goods. And that's why lots of economists have been so pessimistic, because historically that's been a great predictor of what happens in the economic cycle. And what has come to the rescue, not just in the UK, but in the US, revenge spending and leisure activities took off and hasn't reverted to anything like a new normal. It's almost like we've achieved a new normal and we're staying there. If that trend continues, then quite frankly, you know, a lot of our models of where consumers go and spend their money, which we assume always means reverts, are just wholly wrong. I think it's a big imponderable in the composition of which sectors win and which lose.
We have one more question and then we will wrap up. If you could pass the mic down the row, thank you.
Thank you very much. Maybe my question to everybody in the panel, but mainly to Simon about, firstly, are we ever going to see the interest rates on debt for less than 1% again? Are they going to come back one day?
Yes.
If yes, when?
No. Come on. You had one question. Yes.
And the follow-up question is that if we were going to see them again, how is going to impact the rent market for the properties? Thank you.
I'll venture it will happen again, but most of the people in this room will be dead when it happens, so you don't need to worry about it. Look, sorry, I will be more constructive. Sorry, I haven't even had a drink yet. Structurally low interest rates of the type that we saw after the global financial crisis look very unusual if you look at the sort of on a multiple millennia basis. So it doesn't look very likely in our life cycle, but it is such a massive question for so many asset classes, not least property around the world, that investors always ask me a very, very similar question or a version of that question. The one thing I would say is that some of the very factors that drove interest rates very low in the aftermath of the global financial crisis are still very much in play. We're very indebted. It's quite an aging population. We've got a surplus of capacity of goods on the global market, which is quite disinflationary. So you could say that those factors could reassert themselves. The problem is, if you like, that a lot of what we're seeing in global politics, and we haven't mentioned, or I think I mentioned him once, Donald Trump, if he instigates what is in effect significant protectionism for the world's biggest economy, that is quite inflationary, and therefore all else being equal, it's quite difficult to see interest rates from the world's major central bank, the Federal Reserve, being able to cut to anything like zero, which quite frankly, if they did, the rest of the world would have to follow. So I think on any reasonable investment horizon, with Trump in the White House, with global conflicts, with it looks like a lot of populism still to play out that looks in any country's guise more protectionist. Look at Spain, look at France, look at Germany's election next month. Probably most likely government in the UK next time around is reform. Quite protectionist entities. Those look quite inflationary and not consistent with the kind of cost of capital environment we had pre-COVID.
Thank you. That was great. I'm going to finish off and ask each one of the panel to give us one thing to watch out for this year, whether it's a key trend, a challenge, or a new operator.
Well, you probably realise what my favourite was. It was Phantom Peak. So they will be looking for a new site, and they've got another concept that they're looking to roll out as well. So going to the next iteration of that. Otherwise, I think for leisure, so I'm going to have two, something I didn't stress is that each of these big leisure boxes cost a lot of money to fit out. So that industry or those operators only have so much capacity a year. So for Lane 7 to do 7 new openings in a year, that's going some. Most people are less than that. So for landlords, it's making sure you work hard to achieve those operators in your schemes.
And for me, I think we'll see a bit more franchising and more independence opening up.
Lovely.
Just going back to the interest rate question, a lower cost of debt affects everything in the life cycle of property. Hopefully with a few interest rate changes, perhaps as many as you're predicting, we're going to be in a better environment for everybody investing in the sector.
Yeah, and I'd finish by saying, while it's not specifically to leisure, the June spend, whatever you think of the budget, and it's come up time and time again this evening, it comes up with all the conversations I have with clients, there is a shift of spending power away from employers towards the state. The state is going to spend that money this year. It's going to run a bigger deficit this year than it did last year. Where it spends that will make, I don't know where Trowbridge is, by the way, but I suspect it's on some Treasury official's spreadsheet going, we're going to have to open a prison there. And therefore that spending, other public service. And therefore, have I just destroyed a deal for you? It's Scotland, right, okay. No, don't say it, Simon. Right, but we will get clarity on where that money is spent. And I think we were talking about the strength of regional spending. I think that trend in the second half of the year where that public sector money gets allocated to projects around the regions will be a big moment on regional growth rates.
Thank you. And just before I hand back to Ashley, big thanks to all of the panelists. Thank you.
And I'd like to thank again CBRE for graciously hosting us tonight. Alice, thank you for chairing the panel. That was fascinating. I learnt a lot. I learnt that Nigel and his wife are trying to single-handedly save the restaurant industry. I learnt from Sammy I need to invest in Manchester, so I'm going to start that tomorrow morning. I learnt from Ed that he doesn't like Trowbridge. I'm from Wiltshire, Ed, and Trowbridge is the county capital of our county, and I agree with you. And I learnt that Simon has too many cushions in his house. But apart from that flippancy, it was very useful content. Thank you to all of you for coming. Thank you to those watching by video. We now have a networking session. But before you all disappear to get some drinks inside you, March, we have the LPF dinner. There are still some tables, but we're booking out very fast. We're in the Hilton Bankside this year due to popular demand. Lots of people are signed up. All the big decision makers will be there. Try and get those last few tickets to attend the dinner. In April, we have a fascinating seminar coming up on franchising, which will be a really hot topic, as we saw tonight. Absolutely. Webinar in May, so you can watch some stuff at home or on the train. And in June, we're getting ready for our behind the scenes. And as you know, we pick a really cool leisure venue, and we get to go around it as a group and see the inside story about what's going on. So lots coming up. Keep your eye on the webpage. Thanks again to the panel, and let's all network. Thank you.